Just checking to see if everybody can hear me okay. Everybody see the screen? Everybody looking good? Everybody feeling good this morning? Uh, Check those levels of frustration. Hey, Dr. T, I was just wondering, what's with this market direction model? It's like it acts less like a timing model and more like an oscillator.
Yeah,
And,
these days in this market,
and
it
yeah,
certainly
so I was
does.
wondering, what do you make of that? Now, the way I look at it, let me just throw in my 2 cents. Is that you break down and you catch so you actually go to a sell signal on the day that the Nasdaq's kissing the 50 days. So I think it's logical that you get a bounce, and of course the bounce is just enough to take out the fail safe, and then they roll it back the other way, which makes you think the market's watching us, and now you're coming back into the 50 days. So you're kind of like you're neither here nor there at this point. You could break the 50 day, you could find support and bounce along. What's your take?
Yeah, well, it's the model is not designed to catch little wiggles, but it is designed to be safe. In other words, to limit losses on the downside if the signal is false. And yesterday, you're exactly right. It's just kissed the number on the Nasdaq. And actually, I've monitored some other indexes as well, and it's just literally at the peak. That's where the model went to a neutral position. And of course, this has happened before. Sometimes, the model will get taken out by its failsafe, and then the market will head lower or it'll head higher, depending. The model is not to be. When we doubt the model, then it doesn't pay off for us, like last August when it had a huge gain over a period of signals.
Right, and a
Um,
lot of people
and
doubted that signal, including us.
Right, and the reason was because up until August 2nd of last year, the model had a number of false signals leading up to that true signal, and simply because the market last year was mostly trendless and volatile.
Right.
But then that is the rhythm of the model. If you look at prior years that were challenging, you might get a series of false signals, and then that final true signal makes up all the difference for all the losses. And that's how the model last year was able to do. I think it was up about over 11% using the Nasdaq Composite, whereas the Nasdaq Composite was down a few percent. And if you use TYH, I think you were up something like 38%. So choosing the right signal is very challenging, and I don't recommend it. I think a lot of the people who are successful with the model are the ones who just stay with it through thick and thin. But psychologically, it can be tough, especially when you get action like we saw yesterday, which kind of wiggles you in and wiggles you out of the position.
Yeah, I mean, it seems to speak to the anomalous sort of environment that we're in that's mostly QE driven. I mean, I read today that uh, mutual fund investors have been pulling money out of stocks at record amounts this past month, and I know that they've been doing it over the last couple of years. You've actually seen net outflows, yet the market's continued higher. So it seems to argue for this continued sloshing of QE, and it seems to slosh one way and slosh the other way, and they're able to create this rally. And you have some leaders moving, and it's possible to make money in individual stocks. The index has become a difficult animal to deal with, especially when you get these kind of breaks, and everything starts to look ugly. And it seems to me in the old days, I hate using that term, but back in the 90s, when you started to see a series or a confluence of say deleterious or negative action, usually you're in trouble, and you can pretty much count on it. And these days it seems like they can manufacture these bounces. But I've gone back and looked at some of the old days, and there's a lot of volatility and patterns. And as markets break down, there's some jagged action. I think if the premise of the model is to try to limit risk to 1, 2, 3% losses on a bad signal, then it's probably doing what it should be doing. I guess for most people, that the question then becomes, give me 10 of those signals, I'm down 30%, and so that's kind of can become the issue there. So I think what happens though, if you find your account dropping, what you have to do each time you come in, you may come back in a little smaller. So in other words, rather than trying, if you get dinged by 5 bad signals and you're down 15%, say, rather than trying to come back in the next time with a full position, maybe you can edge your way in. That limits the risk so you don't keep taking these big dings. Of course, you'll never be big enough when in your position size when the model finally issues a signal and the market breaks down 20%. And if you look at this chart, you can see the move from late December. And really with a sell signal, what you're trying to catch, and I would even speak from the short side in terms of attacking stocks, and I'll get to that in a little bit, you're really looking for a break like this, to the downside. That's pretty significant, okay? And so whatever little ding in here that you get, when you look at it on a chart, this looks like nothing. And from a practical standpoint, it is. Really the real issue, I think, with the model, objectively, is this continuous little dinging, and you take every time, and the bad signals that whip you back and forth. And how do you handle that? And I think that's what becomes an issue. So if you come back in every time with the same size position as you're drawing down, you're going to get dinged 2-3% with each bad signal. You get 10 of those, you're down 30%. But what would happen is, as you're coming down, you would probably want to drop those positions so you keep your dings closer to 1.5%. Once you start coming down 10-15%, because we still want to be in a position to come back when you get a good signal. And I tend to think that'll happen at some point, probably when everybody's pretty well disgusted with the whole situation. And I find myself getting that way sometimes, and that's why I like to go after individual stocks on the short side when the market's looking floppy. It's the same thing on the long side. The market direction model didn't give us a buy signal until later in January, but the market was already moving. And on that basis, you can take a stand in terms of the short side coming after individual stocks. I'm not talking about Michael Kors, but we picked off Jazz pretty well. I can see this thing. I like this reversal. I'm just, again, screening for short sale ideas. I don't use special screens. I just look at my old buy list. When the market was going up, my old buy list becomes my short sale target list. When it starts going down, and the stocks, some of the stocks, leading stocks on that list, start to break down. Jazz being one of them. It's been pretty sloppy for a while, and I know Dr. K has not liked this thing since it had that bizarre 20-30% spin out or more, whatever that was, way back when.
Yeah, several months ago.
Yeah. I mean, so you've never been a big fan of that, Dr. K. So I thought, that means it's got to be a crummy stock. So you make this V-shaped pattern. Notice there's no real buying volume here. If you look at the weekly pattern, you kind of see this. You see the light weekly volume. So people will ask me, what are you looking for on a late-stage failed base? Leaders starting to wobble a little bit, and this sort of wedging rally, and then you pick up. Going through my list every day, which is what I do, and I'm doing it several times a day, I pick up this action, and it's reversing hard on heavy volume. And on a day when somebody upgraded the stock, so to me, this is a late-stage base failure. The next day you had a nice chance to short it. We talked about it right in that high 48 price area, and the thing broke down real quick. You get about, not quite 10%, but you can see here it undercuts this low, so this becomes problematic. In that you've undercut both of these lows, this low here now and this low here. So I think you're kind of in cover land and taking a profit. I know I did. But I'm kind of hanging out and watching to see how it handles this area if it becomes resistance and it breaks down further. Because I think ultimately, if the market remains weak, I think Jazz could get to the 200-day. And then you might get some sort of significant bounce. But you have to remember, this is a late-stage base failure or late-stage failed base. LSFB or LSBF, depending on whether you want to call it a failed base or a base failure. But, it's all about labels and acronyms, right? But, no, not really. It's all about watching the price volume action. So this one, you already had a gap down here on heavy, heavy volume, so you knew this was kind of weak. And that's kind of where you are with Jazz. CF blew me out really quickly. You see 1, 2, 3 breaks of the 50-day moving average. The one thing that I was kind of questioning in the back of my mind when I saw this is that when you come down 3 days like this, you see here's the break here, and you see the volume here. Here's the second break here. You see the volume here. Those are pretty heavy volume days. And the next day, though, it bounces right back above and closes back above the 50-day moving average. That's the blue line right here, okay? So yeah, what you have here, this is actually a violation of the 50-day because you close below here and then you move below that. So it seemed to me that with this rally up into the 50-day here, that was shortable. It's gone past, and it goes past about 3, 4, 5%. So you notice the thing is reversing today. It could still be shortable if it breaks the 50-day on some volume. And then my target might be one of these lows. This low, I don't know about this low, maybe 175. That's really not that much. I think maybe this low combined with the 200-day, if that works. But, there's been a bunch of these patterns, cat, these big, ugly type of pod formations, CMI, that's less of an ugly pod formation. But see, these have already broken down through the 50-day or the 10-week line. And so you're watching for rallies to short into. Notice how CMI gets resistance down along these lows when it tries to bounce up. But these are things to keep an eye on. I think if the market does continue to weaken, I don't think the verdict really is in. The crowd wants to buy the dip, I think, and so I think you're prone to these upside moves. And then there's talk that there is QE, there isn't QE. The Europeans were buying bonds the day before yesterday, so they're pumping liquidity into the system. So you get a lot of that sort of QE sloshing that occurs. And I think you're just sort of seeing things flop around. Whether the market continues to break down will be interesting to see. But, to that end, you look at Apple here. Now, Dr. K, Apple actually closed just a few cents below the 10-day moving average. I think it did that somewhere in here too, but you don't count that as a close below. It's too close, right?
Yeah, basically, you can tell if it's closing on or just around. In other words, around the moving average would be based on its volatility and chart pattern. And if you can see it on, if you visualize it on the chart as it looks like a close on the moving average, that for all intents and purposes is a close on the moving average. So,
okay, so close below.
Yesterday's close was, a fraction of a point below, but it's also trading at, at 622. So, that would be a close at the 10-day. So for it to violate the 10-day, we would take a move below today's low.
Right. Okay. So you could be down a lot more before you actually get the violation.
Right.
Yeah. Okay. I don't know. I think Apple's got to come down a bit more. In the past, it's tended to find support at its 50-day. I think if it built a whole new base, the 50-day would be support. That depends, of course, on the market continuing to come down. But when you see Apple breaking down, and I thought this was kind of a clue yesterday, is that Apple was actually down for the day yesterday, even with the indexes up. But that kind of rally, if you're trying to short into it, it's very hard. So you'll be getting pinched in certain areas of your anatomy that may not be exactly fun. But sometimes if you're shorting into these rallies, it does pay off. If you look at something like Amazon, and we talked about this a few days ago, and I'm looking for a bounce off the 50-day moving average. You got that yesterday. Not a lot of volume here. And now you're breaking the 50-day. So I'm kind of watching this. Potentially, if you draw a trend line along these lows, you're basically coming down to it. I take a small position short, anticipating the break, and if it occurs, then go bigger, using the high of the day maybe as a stop, or you could use a lower stop. But that's how I would approach this. I also wouldn't be too bothered by the fact that it's come down off the peak above the 200-day moving average and above the $200 price area. The thing is, if it's like a stock going to the upside. If it breaks out through one of these trend lines, like this would be a trend line breakout to the downside. If you were looking at the actual head and shoulders, let's make this smaller, and I'll draw a line here. You're looking roughly at your neckline down here. So I see a breakout here could carry down into here, undercutting all these lows, undercutting this low, and bumping here if the market continues to get weak and Amazon breaks down. But this is a big head and shoulders formation. You can see there's even a little head and shoulders in the head, okay? And that also worked and broke down from that neckline when that occurred. So now you got a more of a macro type pattern or a bigger pattern forming here, and that looks pretty ugly. And it's actually not uncommon. You can go back and look at the examples in the book I wrote with Bill O'Neill, How to Make Money Selling Stocks Short. It's still out there and still in print, and it still sells pretty well. I noticed people get really interested in it every time the market starts to come off, and I saw several people emailing me, was it Tuesday, about it and where they can get the book. And of course that's the point where the market bounces. You can almost use it like a barometer, but in any case, I think if you are starting a bear market, you're still pretty early. But there aren't a lot of setups. So here's one, and it's very common if you look at the examples in that book, for the stock in the right shoulder to go past the moving average, either the 10-week, 50-day, or the 40-week, 200-day. And that can happen. So you want to watch for that kind of stuff. And I think if this thing breaks out below this, through this trend line, this rising, lows trend line, I guess, whatever you want to call it, you're probably heading to the neckline down in here somewhere, undercutting these lows somewhere. So, that's one place to be. Anyways, what else do I see on the short side? Not a heck of a lot, actually. So, you're still early, and that's okay. it doesn't have to all be there right away, but I think you pick off something like Jazz, and that's working. I think Amazon probably is a short right here, and you can use the high of the day. You can test the position anticipating a break here on the downside. And so I find rather than trying to play indexes as the market gets weak, it's actually a little better to try and play stocks because, number one, if you're shorting stocks, the only thing you're looking to short is something that's already weak. So it may continue to work even if the market's up. And a good example of that was Jazz yesterday. So a lot of times on the short side, selling stocks is more productive initially because stocks start to break down as the indexes start to wobble. And so, the market direction model gets a couple of bad signals in here. You may get a good one on the sell side that becomes a big move or pretends or predicts a big move to the downside. And, you're in the pink on that one. So I think there's two ways to kind of look at it here and not necessarily get hung up on what the market direction model signal is in the short term. Right now it's neutral, which means if something's working on the long side, maybe you could try it. There was a pocket pivot on LinkedIn, a little V-shape though, so it's predictable that it finds some resistance up here and pulls back. If you want to go long LinkedIn, I guess you could. I don't know. I think you're still looking at a general market question, but it's acting constructively. And what I would love to see it do is actually break out through here, because then you know that the real move is starting. Because if you look at LinkedIn, all of this is nice, but the real move in a lot of these, well, the real move in any leaders, it begins when it starts to break out of its base, when it actually clears it. So you haven't really seen that yet in LinkedIn, and when that does occur, that probably is going to be a good move to play. But right now it's a question of what's the market doing and where are we going with that. Otherwise, you see some weird action. V breaks down, gets a pocket pivot yesterday. Intuitive Surgical actually closes below the 10-day, violates it here, and then flips back above it with a pocket pivot yesterday, and now it pulls back on top of the 10-day. So, this kind of stuff will tear your hair out too. But if you bought Intuitive Surgical on any of these gaps up and any of the pocket pivots along here, it's held the 10-day. Theoretically, a violation of the 10 days where you sell it, but it flips right back above it, so it's holding it intact. So I thought, though, IBD had a good comment in the big picture. Are some of these leading stocks having a last meal before they walk down Murder Row or whatever it is, Execution Row or whatever, or off to the gallows? Maybe, I don't know, but it's kind of a question of how many more leaders do you start to see break down, and some of them are trying to hang in there. So we may be early in the game on the short side. So somebody asking about the tornadoes. Well, I was watching the weather last night, and they said there is an weather advisory for high winds, and apparently this storm that's coming in has a bunch of little substorms within it that are spinning, and they can spawn small tornadoes or water spouts. We get those from time to time, but it ain't like Dallas. That's all I got to say. But it is funny that I was pointing out to my Dallas friends why I don't live in Dallas and I live in California, with the idea of eventually taking my state back from the liberals. But then we get this kind of little egg on my face, so we get some tornado warnings. But it's just pretty minor, so we'll see. Did the fail-safe cause the market to switch prematurely? Dr. K, all we did was rally to the 10-day and the moving averages on low volume.
No, what's the question? Did the fail-safe cause the market?
It's maybe like I was saying, the MDM is acting a little bit like an oscillator here, so maybe it did. I don't know. Did the fail-safe, excuse me, did the fail-safe cause the market to switch prematurely? I think the market direction model to switch prematurely. All we did was rally to the 10-day and the major indices on low volume.
Yeah, well, the model doesn't look for the model doesn't use the 10-day on these averages. There's no statistical relevance with the 10-day and the 10-day moving average in these indices. All it does is its primary importance is on a signal to contain the downside risk. That means the fail-safe is the fail-safe. It can adjust itself based on a number of variables, and it will do that intraday. That's why for me to say, well, the failsafe is going to be at this level, it could change. It could change in the middle of the trading day.
Right.
So what happened yesterday was everything lined up so that the failsafe was triggered, and that happened to coincide with the basically the very close to the high of the day.
Yeah, the market is probably a subscriber, and so it's just watching for that signal to go the other way. You know, that's what you start to think. It makes you wonder, though. But anyways,
Yeah,
but
and in the
that's
history
pretty
of the
much it.
model, I mean, this sort of thing has happened. It will happen again. It's just that's one of it's sort of like buying a stock, and the stock triggers your sell stop, and then moves on up from there. Kind of
Yeah.
like LinkedIn is a good example of it can be very frustrating to trade certain stocks if they just hit your sell stop and then move higher.
That's the way of the market, though. So if you've been
Yeah.
around the block a few thousand times like we have, you kind of have to grin and bear it. Dr. K, can you repeat what you just said about the market direction model and hanging in there?
Yeah, well, if you look at the history of the model, you'll see there are periods where it gets several false signals in a row, and that's why we always encourage everyone who comes to the website to really look at those results so that they will get a sense of the rhythm of the model and also get a sense of the weaknesses and what they can expect, so that should the model have a series of false signals, they're not going to just throw in the towel. And what I've been pleased to see is that very very few people, or at least have expressed that kind of frustration where they throw in the towel. It seems like most people do stick with it. But that said, someone can say, okay, I'm going to stick with the model and still only trade every other signal or trade 1 out of 4 signals, which over the long haul of the model, that's okay. You can certainly do that. But that might also mean you're going to miss some of the big wins that the model can score. And I think
Right.
August of last year, the August 2nd market call, which was then followed by there were 5 successful market calls in a row starting in August 2nd. That first signal was very profitable. I think it was the most profitable of the series, but that was the one I think most people didn't believe, including ourselves, simply because the model had been giving false signals for a good part of 2011, simply because the market had been trendless. But the model statistics show, it's something like TYH or a number of these other 3 times ETFs, not the TNA, but the TYH did very well, and there are quite a few of these 2 times ETFs that using the model did over 20 to 30% last year.
Yeah. But it's that kind of environment. It's very difficult and whipsawing. And if you're paying attention to
QE makes it even more tricky. I mean, QE was what knocked out most models in 2009, 2010 because they couldn't account for it. And when I say most models, the very few that were out there that had good track records. And now QE is still here, so the model naturally takes that into account. But it's here in, it seems, a less obvious form. So that further adds fuzziness to the market environment. And actually, as I pointed out in yesterday's report, the trend following wizards as a whole, most of them are still down this year, and as a whole, they're all down as a group, which is very unusual. It speaks to the strangeness of this and challenging nature of the environment we're in 2012, despite the market moving up in a fairly trending manner.
All right, people are asking about some stocks here. Let's look at. We already looked at LinkedIn, but F5. Somebody's saying here, F5 breaking down entry point. So I mean, I wouldn't be buying a stock that's gapped down through its 50-day moving average. That's all I have to say. Price line. It has closed below the 10-day, moved back above yesterday. So another close and then a move below that close would be a violation. But so far, that's not happening. Let's see. Lulu has closed below the 10-day, but it tends to be sloppy around the 10-day. So you're not using that as your selling guide. You're using the 50-day moving average, and it looks like it's headed for that here. That's how it looks to me. How about you, Dr. K?
Yeah, it looks okay to me in terms of. Wait, hold on a second. My computer is doing some strange things, and you are blanking out now.
Uh-oh.
You know what? I'm going to reboot because
Okay.
I've seen this before. It's better than me trying to fix
All right.
this.
I'll carry
Okay.
on.
All right.
Somebody asking about fossil and is it a pod? Well, it's not. It may be a big pod. It certainly has that look, and you basically want to watch and see where it starts to break down. Hasn't really done that yet, but it wouldn't surprise me if it did. So what I would do is, I see a lot of these patterns, and they are in former leaders. Fossil is very hot, so you come down. It starts to look like a big ugly head and shoulders. It comes out of it, but you get some big upside volume, buying volume in the weekly chart, and you'd have to wait for it to break down, and then it takes some time rallying back up into the 50-day before it comes apart. So that's kind of premature. But I would watch a lot of these patterns. Remember a few weeks ago, when we did have a sell signal before in the model, a few weeks ago, and I pointed out, I think it was around in here in early March or no, in February, I guess, that you have some of these patterns. CMI. You look at CF, kind of looks like a big ugly double bottom that is improper. Cat, the same thing. And there are a number of these that look like this, and they can break down. Fossil is one of them as well. I think Tiffany was something like that. Tiffany's looking kind of weird and ugly as well. So some of these retailers are looking a little bit funky. Somebody asked, so with few pocket pays and market direction model leaning toward a sell. As far as I know, the market direction model doesn't really lean. It just either gives you a signal or not. So I couldn't tell you which way it's leaning. I've never seen it lean. In fact, I've never even seen the market direction model as some sort of entity that would be capable of leaning. So anyway, Ann, too thin for me to short. I would not short it. Nuance. Can the MDM go back short in next 2 days? It could go back to a sell signal, yes. No, the failsafe does not keep it out of the short or sell signal for a specified period of time. Somebody says here, the change in the MDM just means we're one signal closer to the big money move. I sure as hell hope so. That's all I have to say. Are the MDM results based on end of day or intraday switches? I think they're end of day, so I don't know. You have to look at. I think there's an explanation of it on the website, but we can ask Dr. K when he gets back on. People are asking about percentage of profitable signals. I don't think it's a percentage of profitable signals that's key. Just like I don't think that you have to be right every time when you're buying a stock to make big money. You can be actually wrong 4 out of 5 times, and if that one time that stock goes up 300–400%, you're gonna make a lot of money. I know that was how my 1995 worked out for me. I was wrong probably 9 out of 10 times and down 30-something%, and all of a sudden I bought CQ that took off, and I was up big. So I think with the model, it's not really a question of how many your hit ratio, in other words, how many good signals versus bad signals. It's how much does a good signal produce when you actually get one, and that's more what I'd be concern of. Sorry, F5 starter position for short side. Oh, okay. So somebody asked about F5. Nah, I'm not gonna start on this one just yet. But see, here's a pod. Okay, so this is breaking the 50-day. Yeah, you know what? I'm gonna have to take that back. This is a pod. You're breaking the 50-day, the 10-week line. So now what you're looking for is any kind of rally up here. But it looks to me like, yeah, it could if it fails here. If you wanted to try shorting it here without thinking it's going to come and fill the gap, then yeah, you would be using the high of one of these days as your stop. I guess it would be this day. And that's a possibility here. You'd be looking for a breakdown to 120. So yeah, that could work. Sorry, so I had to take that back. I had to look at the big pattern here. But yeah, that's a good pod. All right, Henry, you're on it, baby. Tractor Supply. I don't know. I'm waiting for Fred Richards to call me up. I think Fred owns it at like 38 cents or something, and every time it goes to a new high, I get to hear about it. But you know, that's just a Bible gap up. So when MDM says cash, do you pass on it? I mean, like you can buy any stock, and they may continue to go higher even in a weak market environment. So I don't necessarily see that you couldn't go long if you caught this thing early in the day. You know, I know people were buying LinkedIn, early in the day as it's starting to come above the 10-day, and it did turn out to be a pocket pivot. I mean, sure, you could buy it. Are you going to make a bunch of money? I don't know. I mean, is TSCO more of a? Is it getting long in the tooth here? or is this just coming out of this ascending flag here and it's going to rock to the upside? That would seem to imply then that the market is going to turn around and go higher. Maybe that's true. But you can buy anything, as long as you have a clear stop. But if you think, the market is actually in an uptrend and it's going to come out of this and you're trying to anticipate that, then sure, you could get long something and try a couple of trades, LinkedIn possibly, anything like that. So anyways, let's see. So waiting for Dr. K to come back on, but he's not. Netflix. It's kind of rolling over. Sometimes these things can go lower. Here's your head and shoulders. There's your big break. Now it's this big macro head and shoulders. So here's another head. It could break down and go lower, I suppose. I tend to look for more fresher opportunities on the short side. But yeah, I could see it going lower. So if you try to trade a trend back to the lows again, that's probably what you're looking at. You may have resistance in this area here. So you could use, if you're shorting, you could use a 10-day as a stop. Your max is probably up to the 50-day if the market turns and runs. But so far, Netflix looks like dog. You know what? Are you holding any individual long positions stocks here? I'm not. I don't know if Dr. K is, but we're not really here to tell you what we own or don't own. If I own something right now, I may not own it 10 minutes from now. I don't like this pattern. This is starting to look like a head and shoulders to me. Left shoulder, head. I don't know if it's Bible for a rally for a right shoulder, but I almost think that if it did, I would want to short it. So this thing, there was a lot of promise in this one. And my feeling was once it broke the 10-day and, it was acting strong in here, it should have maintained, I thought. Once it broke, it was definitely a questionable situation at that point. And I think that it's dog meat right now, and so I'd have to set up again. But I'm not a buyer. And once it violated the 50-day, this is pretty much where you're gone. So, like I said, to me, this is more like a head and shoulders than anything. CSTR. CSTR is a Bible gap up. I actually tried to buy a little bit of it this morning, but blew it out because I thought I had a quick stop, and it wasn't really holding. Now it's sort of bouncing off the lows of the day. It's a tough one. I guess you can, like with anything else, this bar is red because it opened up here, now it's down here. So not really what I like to see on a Bible gap up. You want to see the thing hold the low and be moving higher, or hold the opening price and move higher roughly from there. But so far that's not happening. So you could still buy it now that you know what the low is, which is 66.12, and use that as your stop, I suppose. So, but I don't know where this market's going right now. So UBNT, we talked about that, but not a pocket pivot any of these days. So it's just making new highs. MNST is a monster. It's holding up okay. You can use the 10-day violation of the 10-day as your stop, I think. It has closed. It's a little, maybe, it seemed to hold the 20-day. So I don't know. You can use whatever you want as your stop, but I don't have any guaranteed stops that mean you won't get stopped out and the stock will not turn around and go higher. So, but I think at this point, MNST, you can use the 50-day, but it seems to hold up pretty well. Anyways. Any other questions? Last call for alcohol. Okay, we're getting towards the end of the, what is it, 8:38? We got about 7 more minutes for more questions. But, my basic, okay, here comes something. BAC. I'm not a buyer of the banks. I don't care for the banks. So I know they're trying to all come up around their ugly patterns. JP Morgan might be one of the better ones. Wells Fargo. Some of the local banks have looked better, but I'm not a big fan of the banks right now. And I wouldn't really be messing with them because I don't think you really know where this market's going just yet. Let's see. It says here, the market direction model to sell the stocks, or do you only go to cash on the ETFs when it changes? If you're implementing the strategy with ETFs, then you would do that. Otherwise, you watch your stocks, I think. Yeah, I think it really depends on how you want to handle it. If the market direction model gives you a sell signal, how confident are you that the sell signal means that that's it for the market and you need to dump all your stocks? you may not have to, because if you look at it, stocks like LinkedIn uh, kind of flitted below this low, but remember you could have dropped down and filled the gap and never even did that, so you could potentially be holding that. You could potentially be holding MNST, you could potentially be holding iSearch, you could potentially be holding Visa. So I think any of those stocks are still holding up. So they're, if you wanted to, you could try and sit with them. So it's not that you necessarily have to bail out and run for cover. Course has not violated the 50-day moving average yet, so I don't know what you're using here. It has violated the 10-day, so if you're using that as your stop, then you're gone. Now you got to watch this. It could break down and blow through the 50-day moving average. NQ long. No, that's a thin stock, tiny little stock, so I'm not playing around. Cat, like I said, is a big pod, but it could be in this base and trying to form a base here. You don't really know for sure yet, but I wouldn't be shorting it. Google, I wouldn't be. Yeah, look at that. I wouldn't be shorting Google. It is kind of poddish, but it's not breaking down below the 10-week. I think if I was going to go after anything, I'd be watching Amazon, and I think that's kind of my number one target right now. Fran. This was a gap up, but it's now violated, so it's a thin stock. I don't trust thin things like this, so I'm not really into stuff like this, to tell you the truth. I know there's a viable gap up, but it goes higher. But to me, this is a thin stock. I don't really see what is so compelling about the story. But then, I didn't see what was so compelling about Michael Kors back when it first started to move. Dr. K, you there?
Yep, I'm back.
Oh, you are? Okay, good. Let's see. We got some questions on stocks. Let's see. But somebody says, not a fan of banks, but on a technical basis only. The weekly chart of XLF. XLF. I don't see anything. It looks like a pod. But I'm not going to sit here and buy banks on a pullback. Are you, Dr. K?
I'm going to avoid banks. There's better fish out there.
Maybe you want to talk about the financials for a second. I'm going to take a quick bathroom break, and then we can take a few more questions and then wrap it up, okay?
All right, sounds good. Yes, as far as the the XLF, and it's had been quite a weak index, and then more recently has been showing more strength. In terms of price volume action, there's nothing compelling about banks that I find actionable in general. And in this kind of market environment where you have a trend on your side all year, it basically started at the beginning of the year and hasn't looked back. And so there's going to be, and there have been, some good names out there that are actionable. Of course, Apple is one of them, but there's been quite a few that have done well since the start of the year. MNST, of course, is one of them. There's a number of retailers, other retailers in addition to that have done fairly well, and we've discussed some of these in our reports. Now, as far as one second. Yeah. Okay. So we had a number of Bible gap ups as well this year, and in addition to pocket pivots, and those also have been actionable that we pointed out in reports. So if you're positioned in these things and you're using the 7-week rule, you're probably still positioned in them, because a lot of these stocks, the ones that violated the 10-day, within 7 weeks, you would then switch to the 50-day. And from the looks of what I'm seeing in a number of these stocks, you'd still be in the position. And again, you wouldn't let the market direction model scare you out of these positions prematurely. We treat stocks differently than ETFs. So in the case of a sell signal from the model, we might tighten up our stops, or if we're heavily on margin, we might take ourselves off margin. But that doesn't mean we're just going to all of a sudden blow to cash in terms of our portfolio positions in stocks.
Right. Anyways, somebody's asking, do you cover shorts at the close? I don't know. Sometimes not. Why does it matter? Would the stop for LinkedIn still be the low of the gap up day a few weeks ago or the low of yesterday's PPR? Dr. K? So
Sorry, you blanked out
LinkedIn,
there. What about PPR?
would the stop be still the gap up day or the low of yesterday's pocket pivot?
That's a good question. Now, that depends on your risk management. I would generally say, in my case, I would prefer to use the low of the gap up day, or actually you can go a few days below that, which would be on the 9th. It went all the way down to 96 and a penny. So I'd probably use that as my stop. But it's entirely fine. I mean, if it goes below yesterday's low, that means it's sunk back into this basing pattern. So you could potentially use that as your first sell stop as well.
Yeah.
And keep it contextual to the market, of course. If the market had a weak pull, had a bit of a weakness and pullback, then give LinkedIn maybe a little bit more room.
Right. Let me asking about this. Not quite PMTC question mark. What does that mean? This is a dog, so I don't know. This you get some pocket pivots and it gaps down like that on news. There's not much here. I don't really see that this thing has to rally back. It could, but to me, lower quality stock. It had some pocket pivots in it, but that's just one of those things where you get hit by news. But there's not too much you can do about it now. If you're stuck in it, you got a big loss in it, and if it's a 10% position, I guess what would it be down for? Almost 40%, less than that, about 30-something percent. So, you're taking a decent hit, but I don't see anything there that would make me come back. I never really liked this stock. Salix has busted the 50-day moving average. If it closes below this low, that would be a violation. That's about it. But it's to me, it's just enough that it failed on the breakout, and it gaps down and fails through the breakout. So I don't really care for this either. But you're seeing some stocks start to come apart. In the biotech area, you saw a bunch of them. Seen a bunch of them do that. And I think this doesn't bode too well for a lot of these stocks, and you just seen them start to come off a little bit. Cubis is another one that's broken apart. Viral Pharma just got blown to pieces. We were out of that a long time ago, thankfully. But look at that. I mean, that's just nasty. And you could see it happening before, but in my view, once it's living below the 50-day, it's gone. I'm not going to short Ryland because it's not really a big leader. Let's see. VMware. Somebody's trying to upgrade it today. I don't know. This almost looks like a shortable bounce off the 50-day. The whole group yesterday was under a little pressure. CRM has been acting better. VMware, F5, all of these looking a little funky. Rack's doing its usual thing where it looks like it's going to take off and then it doesn't. And that's a usual drill on these, on most of these. Do you know anything about TNH, Dr. K?
TNH?
Yeah.
You're talking about the Terra Nitrogen company?
Yeah, I mean, that's a fertilizer
That's
stock,
the
but
leader.
there's not.
It's been a leader in the group. The group actually has a pretty good strength, 10th out of 202 groups. So, and that's been the leader. These other ones like CF and MOS and POT, those are all lagging, and they're fairly substantial in terms of their market cap value. And I would be careful with this group just because a lot of the big leaders, the big former leaders, are lagging quite severely. So it's interesting. The group strength is as high as it is, and I think that's just because it's not market cap weighted. It's more of a indication of just the raw relative strength of each individual stock that makes up the group.
Mm-hmm. I think that's pretty much it. So, we don't have a lot to say. You can see the market kind of rallying back a little bit, but again, it's just bouncing off the 50-day, and we'll see what happens here. But it's a little of this, a little of that, and if you're in a neutral signal, I think it's just waiting for the next sell signal if you're going to try and play this on an index basis. But right now it's just kind of bouncing around. That's pretty much all we have on questions. Dr. K, you have anything to add?
Nope, I'm all good on this side.
Yeah. So I mean, basically, it's cautionary stance in a neutral position. Yeah, there's some longs out there that can be played, but I don't know. It's I think it's kind of a wait and see sort of thing right now. If you have leading stocks and they're holding up, you try to sit with them. Use the typical sell guidelines with the moving averages, and just manage your risk that way. So, but for the most part, you've seen the index is starting to take some heat, really for the first time in any significant way this year. Okay, because you had this one little break in the Nasdaq, it turned out to be a buy signal. And what we always love is you see this melt up on no volume. You try to do that the last couple of days, but it's starting to give way a little bit, and so I think it argues for potentially at least more of a correction, and maybe the market does just go sideways for a period of time before it sets up again. So anything could happen here, and I think it's a question of watching what the leaders do and seeing if we get another sell signal in the MDM, and that's pretty much the deal. It's not too complicated. Got to be cautionary. Use your sell signals, sell guidelines, and see where it goes. But I'm not so sure I would be committing fresh capital to the market necessarily here on the long side because it's still a little bit shaky. Would you agree, Dr. K?
It's a tough environment because the QE is very powerful, and as they say, don't fight the Fed, and that means all federal banks around the world, which are printing money en masse to deal with their severe debt problems, and that's a reality. And so QE is going to be here to stay in one form or another. And in the meantime, we're going to have bumps along the road where the market will get pulled down, kind of like it did in May of 2010 with the flash crash, or it did in August of last year. And predicting those periods is an impossibility. You just have to look at the price volume action and then respond to the model signals accordingly. And in this kind of environment, there's perhaps going to be more false signals than normal. But when it does hit those true signals, last year was the most challenging year in the history of the Nasdaq, based on its trendless volatility, and the model still was able to beat the market. So I would just deal with a smaller position size. If we have it's the only type of negative emails, and we don't get too many of these. It's just once in a while get someone who put their whole account into a 3 times ETF. And I was just like, well, that's not smart. If it's beyond your risk tolerance level, that you shouldn't be doing that. 3x ETFs are incredibly volatile. So maybe you want to put 10% of your account on, allocate 10 to 20, maybe 30% of your account on the model's change of signals and go in on that full amount that you've allocated with each change of signal. So if you get 5, 6 false signals in a row, you have a drawdown that you can completely stomach. Because let's say you had a 30% allocation and you had a 15% drawdown. Well, that would cost your account a total 4.5%. And if you can live with that, then maybe that's the right number for you.
Makes sense. All right, everyone. Thanks for. Oh, wait. Do you follow the relative strength numbers from IBD? Well, we use O'Neill's institutional products, so I guess so. Anyways, last question. That's it. Thanks everyone for listening, and we're just cautionary and play it cool. That's all we have to say, and we'll see what when we get another signal in the market direction model. All right, take care, everyone. Bye bye.
So long, everybody.
The organizer has